$562 billion. That is what American farmers owe right now, this year, this month, today. I want you to stop for a second and let that number register. This is not the national debt. This is not the debt of transnational agribusiness corporations with offices in Manhattan. This is the debt of farmers, ordinary people who get up before sunrise, who know their cows by name, who look at the sky every morning and pray there won't be a late frost. People who simply wanted to feed this country and live by their own work on their own land. And every single time, every damn time, someone raises this topic, when someone says this number out loud and asks, does it have to be this way? The answer is always the same phrase. Bank managers say it. It gets repeated at AG conferences. Neighboring farmers say it. Fathers say it. Grandfathers say it. Well, that's just how the farming business works. Debt is normal. You can't do agriculture without credit. This phrase has been repeated so often and with such confidence that it stopped being an opinion long ago. It became an axiom, an assumed fact that nobody questions. That phrase is what we're talking about today. Not how to properly structure a loan, not how to refinance debt, but where the idea that living in debt is normal for a farmer came from in the first place. Who invented it, when, and, most importantly, who it benefits. Because every myth has an author. This one does too. Before we go further, please subscribe to the channel. Your support means everything. Let's start at the beginning. At the moment everything changed. After World War II, America was experiencing an economic expansion it had never seen before. Industry that had been running on war production switched to peacetime. Factories that built tanks began making tractors. Chemical plants that made explosives pivoted to fertilizers. The synthetic nitrogen used in munitions turned out to be an excellent base for ammonium nitrate. The country was full of energy, money, and ambition, and agriculture looked like an obvious place to invest. It was in the early 1950s that U.S. Secretary of Agriculture Ezra Taft Benson said the phrase that every American farmer still remembers, even those who don't know who said it. Get big or get out. On the surface, it sounds like blunt but honest business advice. Be competitive, scale up, adopt technology. But think about what that phrase meant in practice. It meant one thing. To expand, you need money. To buy more land, more equipment, more seed, you need money that most farmers didn't have. And the only way to get it was credit. That's the exact moment banks and agribusiness saw a massive opportunity. The American farmer was being converted from an independent producer into a permanent customer of the financial system. And to make that work, one crucial thing had to happen. The farmer himself had to be convinced this was right. That credit wasn't weakness or risk, but a sign of business-minded thinking. That borrowing to grow wasn't dependency, it was investment. That debt was normal, and it worked so well that 70 years later, this idea lives in people's heads as unquestionable truth, even though nobody ever proved it. Now let's look at what this normal has done to American farming over the past few decades. I want to speak in numbers, not abstractions, because numbers are not opinion, they're fact. In 2025, Chapter 12 farm bankruptcies in the United States increased by 46%. 46% in a single year. 315 operations declared bankruptcy. The year before, it was 216. The year before that, even fewer. 3 consecutive years, the number has climbed. And that's just the official count. Only the operations that made it to a courtroom. Behind every official bankruptcy are dozens of farms that quietly sold their land, shut down without any announcement, or simply ceased to exist without appearing in any report. Researchers at Purdue University, one of the country's leading agricultural universities, conduct regular surveys of farmers across America. Here's what they found. 1 in 3 American farmers today is not meeting the payment schedule on their operating loans. 1 in 3. These are not failures, not bad operators, not people who mismanaged their farms. This is a third of an entire industry. And yet nobody says this out loud, because debt is normal, right? So struggling to pay it must also be normal. The average operating loan for an American farmer grew by 30% last year. Not because farmers bought more, because everything got more expensive: fuel, fertilizer, parts, insurance. The farm didn't grow. Production didn't grow. Only the debt grew. And with it, the time to pay it off? The latest data shows the average operating loan now takes 3 months longer to pay down than it did a year ago. 3 months sounds small, but think about what it means. The farmer stays trapped in the debt cycle longer, gets to zero later, and next season, another loan, and again. To see just how systemic this is, not a rough patch but a structural problem, look north to Canada. The farm structure there closely mirrors the American model: the same family farms, the same credit model, the same ideology of expansion. And here is what Canadian statistics show. For every dollar of net farm income, the average farmer carries $23 in debt. $23. You earned $1, but you already owe 23. This is called normal. That's just how the business works. In no other sector of the economy would that ratio be considered normal. In any other industry, it would be called a catastrophe. Before we talk about what to do about it, I want to break down how the trap works from the inside. Understanding how you got in is already half the way out. Picture a typical story. A young farmer takes over an operation. Doesn't matter if he inherited it or bought it. To be competitive, he needs equipment. A decent tractor today runs from $150,000 to $300,000 and up, not a purchase you make out of pocket. He takes a loan. The first year or two, things go fine. Decent harvest, prices hold, payments come in on time. He starts thinking about expanding, because get big or get out, that's what everyone told him. He takes another loan for leasing additional acreage or buying land, then another one for seed the next season because there's no free cash left. It's all going to service the first two debts. Then what happens next is what happens in farming regularly, because this is a living business that depends on nature, markets, and policy. Grain prices drop, or drought, or a late freeze in May, or a new tariff that shut down an export market. The crop came in, but it brought in less money than expected. Not catastrophically less, just less, but that just less is enough to miss covering all the loan payments. The farmer goes to the bank. The bank offers restructuring, stretch the debt another year, lower the monthly payment. It sounds like help. In reality, it's just an increase in the total amount paid through additional interest. The farmer agrees because there's no other way. You can't just walk away from a farm. Next year, the same thing happens. And the year after that, the debt doesn't shrink. It takes on a life of its own, grows, rolls from one season to the next. And at some point, the farmer realizes he isn't working for himself anymore, that everything he produces goes first to cover interest, then to cover operating costs, and only what remains, if anything remains, is his income. Technically, he owns the farm. In practice, he's a hired hand working for the bank, paid not a wage, but the right to stay on the land one more season. This isn't a made-up story. It's what farmers describe themselves in interviews, in forums, in bankruptcy court filings. Again and again, the same story with different names in different states. Now let's talk about who benefits from this system. Because if someone is losing, someone is winning. Money doesn't disappear, it flows. The first and most obvious beneficiaries are banks and lending institutions. In 2025 to 2026, interest rates on agricultural loans are at levels not seen in 20 years. The Federal Reserve raised rates to fight inflation, and agriculture, which runs on credit, absorbed that blow at full force. Banks, on the other hand, are recording record margins on agricultural loan portfolios. Rising debt, rising rates, rising repayment terms. That's the perfect combination for a lender and a nightmare for a borrower. The second group of beneficiaries, this is important to understand, are large agribusiness conglomerates. Every time a family farm goes bankrupt, its land goes to auction, and the buyer at that auction is almost always the same: a large agricultural operator with free capital precisely because it doesn't live on debt the way small operations do. Over the past 20 years, the concentration of U.S. farmland in the hands of large operators has grown enormously. Small and mid-sized farms aren't disappearing because they farm badly. They're disappearing because the system is structured in a way that makes carrying debt load extremely hard to sustain. And the large players get larger with every new crisis. A crisis isn't a threat to them. It's an opportunity to buy land cheap. The third group, equipment manufacturers, fertilizer companies, and crop protection suppliers. The logic is simple. The more willing farmers are to borrow for expansion, the more new tractors, combines, irrigation systems, herbicides, and seed they buy. The credit-driven growth model is a sales engine for everything in the agricultural supply chain. If farmers only expanded when they had their own money, sales of expensive equipment would collapse. That's exactly why major equipment manufacturers actively participate in farmer lending through their own financial arms. They sell you the tractor and give you the loan to buy it simultaneously. Conflict of interest? Absolutely. But it's called a business model. When you look at all of this together, it becomes clear that the normal debt story is not just a widespread misunderstanding. It's a narrative that is actively maintained and reproduced by the people it benefits. It's embedded in culture, in education, in banking products, and in agricultural policy. A farmer who questions this norm feels like an outsider, someone who doesn't understand business, when in reality he may be the only one who understands it correctly. But I don't want to end there. Talking about a problem without at least the outline of a solution is journalism for journalism's sake. Let's talk about what a different model looks like. There are farmers, and more of them than you might think, who either never entered the debt spiral or made a deliberate choice to exit it. What do they have in common? Not luck, not better weather, not higher prices on their specific product. They share a fundamentally different approach to planning. First and most important, the financial plan is built before the first seed is purchased. Not we'll see how the season goes, but a clear calculation. At what minimum yield and what minimum price level can I cover all costs and break even? If that scenario is realistic, we proceed. If not, we don't start. Sounds obvious. But most farmers taking loans run their math on the optimistic scenario, not the realistic one. The bank runs it on optimistic too. The bank needs to issue the loan. Second, expansion happens only with your own money or with minimal, precisely calculated leverage. Not I'll borrow and grow and pay it back later, but I earn first, then I invest. This is slower, much slower. But 10 years in, that farmer owns his land free and clear while his neighbor who grew fast has been servicing debt for several years and praying for good weather. Third, diversification as insurance, not as a hobby. One crop, one market, one buyer. That's not a business, that's a bet. Farmers who work sustainably without debt dependency generally have multiple income streams, 2 or 3 crops, or row crops plus livestock, or direct market sales plus a wholesale buyer. When one falls, another holds. This is basic logic that's perfectly well understood in every other business, but in agriculture, it gets ignored constantly. Fourth, a reserve fund. This sounds like something out of a personal finance textbook, and it is. 3 to 6 months of operating expenses set aside and untouched under any circumstances except genuine force majeure. In good years, the fund grows. In bad years, it keeps you from running to the bank for another gap-filling loan. Most farmers who are asked about this say, I have no free cash. It's all in the operation. But that is part of the trap. The system is structured so that free cash never exists because it's always going to service debt. I understand that all of this sounds easy to say. And I'm not going to pretend that, getting out of the debt model is simple. For many farmers who are already deep in credit, the real choices are limited. But this conversation isn't really about people who are already inside. It's about people standing at the decision point, to borrow or not to borrow. about people thinking about starting a farm operation and hearing from everyone around them, well, you can't do it without credit. About young people to whom the entire industry, banks, equipment dealers, AG consultants, is delivering the same single message. Debt is normal, everyone does it. To those people, I want to say this. Everyone does it is not an argument. Everyone does it. And 1 in 3 of them can't make their payments. Everyone does it. And bankruptcy filings have risen 3 years straight. Everyone does it. And the land is steadily concentrating in the hands of the people who don't do it, the large operators who have capital without credit. Everyone does it only means the myth succeeded in convincing enough people. The number of believers doesn't make the myth true. Look at this from one more angle. In any other business, if a third of all industry participants couldn't service their debt payments and bankruptcies were rising 46% per year, it would be called a crisis. It would be on the front pages. Congress would hold hearings. Regulators would act. But in agriculture, it's called normal, because the narrative of debt is normal has rooted itself so deeply that even catastrophic statistics get absorbed as just, that's the farming life. That's the farming life. Getting up at 4 in the morning, yes, that's the farming life. Depending on the weather, yes. Hard physical work, yes. But working your whole life to pay interest to a bank while large conglomerates buy up neighboring land, that is not the nature of farming. That is the product of specific decisions, specific policy, and a specific narrative that someone worked very hard to plant in people's minds over 70 years. And if you see that now, you've already taken the first step, because you can't get out of a trap you can't see. But one you've seen, you can start finding the exit slowly, carefully, maybe painfully, but you can. Leave a comment below. What do you think about this? If you're a farmer carrying debt, tell us what it looks like from the inside. If you're thinking about starting, even more interested in where your head is at. These conversations matter, because as long as we stay quiet and accept debt as normal, the system works exactly as designed. Not for us,